Between March 2000 and October 2002, U.S. stocks lost more than half their value, $7.4 trillion, ushering in one of the most catastrophic financial events in modern history. The once glistening giants like AOL and Cisco suffered massive losses, along with hundreds of internet stocks. These companies, once symbols of the future, saw their share prices plummet. Enron, Tyco, Xerox. These names became synonymous with corporate scandal, leading to widespread accusations of financial fraud at some of America's largest and most respected corporations. The bankruptcies of companies like WorldCom, Global Crossing, and Conseco shocked the nation and erased billions in value, proving no company, no matter how established, was immune. Some of the world's biggest accounting firms were accused of falsifying records, manipulating financial statements, and even destroying evidence to mislead the public and protect their clients. As the financial system crumbled, top executives enriched themselves, siphoning off millions in personal gains while shareholders and employees were left to pick up the pieces. Behind closed doors, analysts admitted that many stocks were essentially worthless, but still, they sold them to the public, prioritizing profits over integrity. Even after the crash, experts warned that the market was still overvalued. Many feared the worst was yet to come, as stocks seemed primed for further declines. With interest rates plummeting and global tensions rising, stocks remained the only viable option for investment. But threats like terrorism and war loomed large, making the future uncertain. Much of the damage could have been avoided if investors had adhered to Benjamin Graham's principles, focusing on value, being disciplined, and avoiding emotional decision-making. In the end, the greatest enemy to investors wasn't the market, but their own lack of discipline and self-control. As Graham wisely put it, the investor's chief problem, and even his worst enemy, is likely to be himself.